Dhiraj, morning. This is Reema here. How do you feel about the markets right now? On one hand, globally, there are inflation concerns which are resurfacing once again. We've been getting that periodically, but usually they die down. But, yesterday's figure that we got was actually quite eye-popping in the US. And plus, out here in India, domestic cases as well as deaths continue to be very high. And markets are just 5% away from their all-time high. So how do you feel, given all this?
Good morning, Reema. Markets' nervousness on rising US inflation, to our mind, will be a temporary affair, as US Fed's statement of not raising interest rates till end 2023 is comforting. So we expect Fed will dismiss inflation pressure as being transitory, and as such expect interest rates are likely to remain low for long with ample liquidity to get into risk assets. I mean, you have to understand that US is yet to witness any strong recovery in their job market. Now, as far as the India market is concerned, post this equity rally, it may be reasonable to assume some consolidation or correction given slowdown in business or economic activity again getting disrupted due to second wave. So the new challenge for business is not on the demand side, as reflected by very strong fourth quarter results and numbers, but on the rising raw material or cost side of the equation or supply chain disruption, including logistic challenges due to state level lockdowns. This may probably have a temporary negative impact on the margins of corporate sector, though firms with better pricing power and ability to pass on cost hikes are better placed. But we expect declines or corrections to be short-lived, with an assumption of a more probable outcome of infection rate trending down over the next few weeks or couple of months. Besides, with lessons of last year, any panic reaction in market will only be bought into. Now, if you look at the corporate capex outlook, it is definitely looking up. Again, after 2 years of continuous decline, driven by PLI-linked investments and growth in emerging segments like data centers. When we analyze some of the sectors, whether it is cement, auto, pharma, consumer electronics, chemicals, I mean, they are doing phenomenal kind of investments over the next few years. So the structural foundation of this bull market is very much on, with low interest rates and earnings revival, despite near-term cost pressures or second wave-led disruption. Nevertheless, it will be suffice to say that overall market valuation is no longer cheap and the days of easy money are behind us. Hence, buy and hold approach in portfolio of superior companies to take advantage of secular growth in the economy is the way forward.
Dhiraj, this correction that we are seeing in metals today, do you think it will be short-lived?
So Prashant, hi. We are seeing commodity prices on a good uptrend, both for ferrous and non-ferrous metals. This is on the back of global stimulus, weaker dollar, and China's import of industrial commodities due to their massive infra spend. The metals universe reported results above expectation as domestic steel companies achieved their highest ever EBITDA on the back of higher pricing and improved product mix. Even non-ferrous are benefiting from recovery in prices of commodities such as zinc and aluminum. Now, what is going to happen is companies are expected, and I have already indicated, to utilize this super cycle profits to deleverage their balance sheet, which is positive. However, we prefer companies with integrated operations, cost competence, and cash flows here. Is going to be only a tactical weight in our portfolio, as we do not know whether these prices will sustain beyond 2 quarters. We are now more inclined to non-ferrous metals such as aluminum than ferrous metals like steel, which may be close to peak of earnings cycle and may not last beyond our mind beyond 2 quarters or so.
Some large cap banks have started correcting. So ICICI Bank has now dipped into the red. Axis Bank is lower by 0.5%. State Bank of India, let's get that up for you on your screen. You could see that downward sloping chart. Dhiraj, so you prefer something like a Hindalco over the ferrous side in the commodity space. What else is looking attractive to you?
So, we have a lot of sectors which are still resilient in the wake of lockdown and cost pressures. We like sectors which are in the agriculture, like crop protection companies or farm mechanization. We have been investing for long in specialty chemicals, non-commodity chemical business, because they are the building blocks for agrochemicals, pharma, or flavors and fragrances that are in the essential category, and that forms a very good part of our portfolio. Besides, we like pharma and healthcare, engineering and capital goods. We believe manufacturing cycle is turning around with corporate capex, and their time has come. cement as a proxy to infrastructure, digital platform or select technology companies in the cloud migration space, as well as food processing companies are the ones which we are preferring at this point of time. Overall, the theme is very clear. There will be structural changes led by import substitution, local manufacturing, and those companies will benefit. There will be ongoing digitization which will benefit many companies. Shift from unorganized to organized sector again is going to happen, and COVID has actually created a larger market share gains for more organized players and as such. So these are some of the themes that we are going to continue investing on.
Agriculture, Dhiraj, without I'm not asking you for recommendations, but what kind of names are you talking about here?
Prashant, we can't offer names because of compliance reasons, but there are clearly many companies which are in the crop protection products with fungicides, insecticides. There are local companies, there are global companies. The business is very capital efficient and scalable. We have seen that. And I think these companies are growing in a very compounding fashion. So by and large, we like companies which have spread of geography, or they have few of the good blockbuster products, a very strong distribution franchise, and connect with the farmers. So both local and the global players offer investment plays here in the sector.